Hey traders, welcome to Charts and Coffee. Happy Tuesday, everyone. Hope everyone's having a good morning filled with a lot of coffee. I will, in all transparency, tell you that I've been starting off my morning with this single origin ceremonial cacao, and then I've been going to coffee. Highly recommended. I've been enjoying that. I've probably been doing way too many espressos every morning, so the cacao has been a good upgrade. All right, so great to see everybody. You know, whatever it takes to get through the absolute lunacy of these current markets. We've got Powell coming up tomorrow. Yesterday, I was sitting in the room with the Sector Secrets Mastery folks. We knew we wanted to overall be bullish the equity markets. We knew that there was support. We know that, you know, with the Federal Reserve going dovish, it's tough to be a bear. And yet, yesterday, as the NASDAQ was going higher, I believe all 7 of the magnificents were anything but magnificent. So if you're scratching your head thinking, where is the organization in this environment? It's really not been there. So I say that because when we lack organization, while the path of least resistance is clearly still up, if you've been following me in the Sector Secrets Mastery Room or in Charts and Coffee or Top Tier Outlook or what have you, you know that we've been bullish and we've been staying bullish because you do not want to be a bear when price is above the 200 period. You do not want to be a bear when Fed Fund futures are showing 1, if not 2 quarter-point cuts by the time we get to July 3-1 of next year. I mean, this is not the time to pick tops. And you might say, well, Rog, what about exhaustion moves? Day trade it, right? Day trade it. But please, please, please do not step out in front of this freight train. Here we are trading at 16,450 on the NAS, punching up to new highs. You know, look at this chart, gang. I mean, really, look at this chart. And I say that because take a look at what's happening here. Because through all of this, all that was really discussed is why this market should be lower, why the Federal Reserve is screwing up, inverted yield curves, and then now that we're at new highs, everyone's a bull. Be careful in places that are not strong going into December because everyone's a bull now. I'm not talking about bear traps and things like that. I don't believe in this notion that higher highs are somehow setting up buyers. Who they're setting up, the danger really is for buyers, and it's always going to be this way, gang. Buyers that buy at new highs are always at the edge, at the tree limb, right? They're at the edge of the limb. They're always susceptible unless the buy is very early in the momentum, which is a topic that would be great to discuss some other time. But ultimately, we have 2 things. We have the rollover gap, which was up. So as we go from the December contract to the March contract, the rollover gap was up. Please, please, please. A lot of folks are thinking, oh, the gap's going to close. Will it? Maybe. Tomorrow? Don't know. Yesterday? Not even close. So remember that gaps will at some point close, but gap closes are not setups. They're really support and resistance. And that might sound different than what you've heard, but you know, folks saying, well, gaps close today? Not so much, right? So remember that what a gap leaves behind is support and resistance for some time in the future. The timing of a gap close is not known, right? So it doesn't matter if it's a gap open on a 5-minute time frame, day trading, or if it's a rollover gap in bonds or in indices. What it leaves behind is support and resistance. Let go of the idea that it's a setup, right? So those are things that are really, really emphasized when we roll from one contract to the next. But again, we want to be careful. All right. Next up is, well, I do want to take a quick peek at bonds and just to, here we go. And by the way, I'm on the TradingView platform. I've got a weekly time frame on the right, and I've got the daily time frame here on the left. And just kind of preparing for the longer term macro discussion that we're going to have this afternoon. Every Tuesday, we set up our portfolio trades. review the portfolio trades, and then set up for the macro. And boy, do we have a macro set up this week. We've got Powell coming up tomorrow. So yeah, big event to prepare for. Swing trades are what's on what I've got on my watch list. What kind of swings could we get? All right. With that being said, let's go ahead and jump into the questions as always. And let's see. First up, Alex. Good morning. Alex asked, curious as to why the NQ futures opened and moved higher all day yesterday when most of the highly weighted stocks were weak. Yeah, I was too, Alex. I was too. And it's not that we're going to ignore. Well, remember, take the gap out, right? It opened higher because of the rollover from December to March. So that's really an artificial gap. It's not a gap because everyone woke up bullish. It's a gap because the continuous contract switches from reflecting where December was to where March is. But as far as moving higher in the morning, no, I think to your point, I think there was a lot of confusion in the morning. Here's yesterday morning. It just wasn't going anywhere. All right, there's Monday's action on bonds. Let's see, Monday's action on the NQ, right? So chop, 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 chop. I mean, it was wandering higher. Right? I mean, it's a difficult time to be a bear, but it was a difficult time to be a bull yesterday because of the individual names. Agreed. One of the things that we discussed in the notes, and I'm going to go take a look at the notes. So some of the things, well, I'll give you an idea, and I totally forgot about this. 4 things we noted, Alex, right off the bat. Those of you that are in the mastery, go take a look at the Monday day trading, the open notes. XLV was green. That's healthcare. SMH was green on getting long Intel, getting long things like AbbVie, focusing on things like SMH. So when I can't find clarity at the index level due to any number of reasons, like my mistrust of why the top 7 weighted names in the NASDAQ are not cooperating with the NASDAQ itself, go to the 7 names and I'm sorry, go to the ignore the 7 names and focus on where the trends are. And trends were in semiconductors. But go figure, NVIDIA was a dumpster fire. Intel and AMD were in fuego. So it was a weird day. But the weirder it gets, as long as your prime directive, right, channeling my inner Jean-Luc Picard, make sure you're focusing on trends, right? Prioritize trends. And if you can prioritize trends from the top down, index sector stock, even better. But yesterday was nuts. Yeah, yesterday was absolutely nuts. All right. So, by the way, I do want to take a quick peek with you all at the economic calendar. So this is the Forex Factory calendar. I like this calendar because it reflects not just what's happening in the US, but it reflects what's going on globally. And those things affect what we're doing in futures and certainly currencies and treasuries. We have our core CPI pretty flat. Those of you looking at this morning's core CPI consumer, here you go. The 2 things about this, gang. When you're looking at the CPI, when you look at the CPI, Consumer Price Index, as opposed to the PCE, the CPI doesn't matter to the Federal Reserve. It only matters to us. It only matters to us. The PCE, this different gauge of inflation, is what is weighted within their models. They're not using this. So there's a weird reaction. It's really more of a reaction to what we as in traders and investors think is really happening versus what the Federal Reserve think are happening. But this is very much in line. There's not a lot here to get too upset about. And we still have Jerome Powell to come. We've already gotten the PCE. So I'm not surprised to see sort of a muted response to, and here's a 5-minute chart. Here's your 825 candle. Here's your 830 candle. I'm not surprised to see ultimately, and you might say, Rog, that's a muted response. Yeah, we didn't go anywhere new, right? Here's a crazy wick, no follow through. Here's a crazy wick down, no follow through. When you look at where we have been, look at the range and where we are. We're nowhere new. So when I look at something like CPI, Tony, I don't get caught up in the wicks, right? We don't want to get wicked. I get more focused on, do we trade outside of normal historical volatility? Take a look at the hourly price movement ranges. We did not. And where are we? What's the net sum, right? Where are we in relation to where we've been? Nothing really new. The important thing about data is, does it take price somewhere that it was unwilling to go before to the up or downside? And I'm not seeing any follow through. It still seems like we're relatively stuck. Wouldn't make sense because, look, we still have Powell to come, and this data is only as important as what the Federal Reserve thinks the data is saying. So remember, data itself, our interpretation, meaning as traders and investors, our interpretation of data is fine, but the only interpretation that matters is, what does Jerome think, right? What does Powell think? Any insight on Amazon for a swing? If I take a look at the daily time frame of Amazon, I want to be a buyer. So then the question would be, where do I want to be a buyer in Amazon? And that's where I'll bring up my hourly price movement ranges. But if it's a swing, it's overnight. So daily price movement ranges. So if I'm looking at Amazon for a potential swing today, probably the 34 EMA wave would be interesting. If not, daily price movement ranges, Richard. I'm going to wait for the historical volatility support levels. Yeah, I do. All right. 30-year bond auction. Could it play Grinch? I don't think so. Here's how we know, right? So Luke, I'm going to say the same thing I tell my members all the time. I definitely don't know what's going to happen. I definitely cannot tell the future, but I sure as heck can measure it. And we all can, right? I may not know what's going to happen, but I can measure what it means. That's rate of change. That's trend. So what we want to do, Luke, if you want to know, is it going to play Grinch? Meaning, could it start to dissuade traders and investors from believing that the Federal Reserve is going to cut rates? Don't worry about December. Stick a fork in it. We're not getting a hike. We're not getting a cut. We're not getting in anything. The monetary policy statement and the press conference will be far more important. Does Powell sound dovish? Move out to January. Move out to, more importantly, March. So Luke, at 101, all right, at one, and by the way, gang, we have bond auctions all the time. And don't get too caught up in them. It's probably going to be as unimportant as yield curve, the yield inversion has been. So don't get caught up in that kind of stuff. Don't worry about it. But here's how you measure it. All right. Here's how you measure it. So when I look at March, which is possibly where we could see a rate cut, okay, 41.7% expectation for the cut, 56.6 expectation for the hold. If after that 101 auction these change, that's where the measuring is, right? And by the way, these are going to move based on jobs. These are going to move every time a FOMC member speaks, especially a voting member. This is going to move every time we have inflation data. Every little bit of insight we have as to what the Federal Reserve is going to do and when, which is what's more important, when are they going to do it, is going to move these graphs around. So take a look at March, take a look at May, and Luke, I have no idea if it will, but I'm not going to worry about it any more than I would worry about any other bit of data. We can just measure it here. And if it's going to be a market mover, then we'll see it measured here. And that way you're not getting caught up in, a lot of the nonsense out there in market speak, which is this could happen and that could happen. And just measure it. I know it's so boring, but world's most boring trader, right? All right. Next up is Jim. You asked an interesting question as far as the rebalancing. I would look at, remember, rebalancing typically does what? Whether it's reconstitution in the Russell or rebalancing in anything, rebalancing favors the overall bullishness of a market. A rebalancing is not going to affect the index as much as it's going to affect individual stocks. Yeah. So Tony, when I look at any consequence of rebalancing, when I look at any consequence of that, it's always at the individual stock level, not at the index level. It typically helps the index, meaning moves it higher. And it typically will really affect the stocks that were expected to be higher or lower weighting, right? Traders and investors will always guess at what the new reconstitution or rebalancing will do to individual holdings. That's really where the chaos oftentimes is. All right. Let's see what else we have here. William asks, isn't the PCE more impactful than the FOMC? Yeah, that's what I was saying. All right, let's go take a look. So CPI is inflation data, the PCE is in their models. All right, moving on then to take a quick peek at the dollar. So the easiest way to take a look at the dollar, gang, is pull up 6E, not DXY, not UUP, not even DX futures. Remember that the dollar is the number one. Well, anytime you're looking at majors, the dollar is what everything else is being traded against. But the euro is the number one weighted currency in the dollar basket. So the dollar is more like an index, right? The S&P 500 is no more made of one stock than the dollar basket is just a dollar, right? You think about all the currencies in it, this is 58%. So if you want to know what the dollar is doing, look at the euro. And I would still be fairly bullish the euro, and that means bearish the dollar. And it looks like we're getting some support above the 200. Not that that's necessarily what's needed for the equity markets to rally. That's another myth I wish would just crawl away and disappear. Equity markets can do just fine, thank you very much, without the US dollar weakening. And if this year did not prove what absolute nonsense that is to believe that the dollar must be weak for equities to rally, let me remind everybody that as the euro is just trying to move higher, which means the dollar is trying to move lower, it's coming off highs, right? The NASDAQ and the S&P are making new highs. So yet another thing I hope 2023 has righted the ship on. Russell leads nothing. Inverted yield curves mean next to nothing. And the dollar does not have to be weak for the equities to rally. All right. What are my thoughts on Oracle? All right. So Oracle, again, I would want to find relative outperformers. So I don't see Oracle as a relative outperformer. So if we crack open NASDAQ, if we crack open SMH, Jerry, if we crack those open and ask ourselves from a relative performance standpoint of the top 5, top 10 names in those sectors or in those indices, is Oracle one of the better looking names? And I can't say that it is, because when I've got AMD moving in an uptrend, when I've got Intel moving overall in an uptrend, those would win out on the relative performance, relative to the sector, performance meaning better quality structure. Now, that being said, high tides do tend to lift all boats, and semiconductors are actually one of the strongest sectors in all of Traderland. Hard to want to bet against stocks that are likely going to move with the SMH, but why not move with the broader sector, meaning let's get long SMH or the individual relative outperformers. But again, high tides lift all boats. The Oracle will probably benefit from the NASDAQ moving higher, from XLC, XLK, XLY moving higher, from SMH moving higher. But all I'll say is, if we're going to be specific about what we want to buy, to me, I want to find the best example of bullish structure. But certainly focusing on that corner of the overall equity markets would make a lot of sense. So I'm with you on that. Now, the other thing to remember too is if the tide is moving higher, the beautiful thing about being long QQQ or SMH is that you're not tethered to an individual name, right? You get a little bit of this dilution effect. So that means that if, let's say I'm in Intel and Intel has news, or let's say I'm in AMD and AMD has news, or let's say I'm in Apple and Apple has news, that stock could get hit pretty hard. But if it's one of a handful of high concentration weighted stocks and I'm long the QQQ instead, it's going to give me a little bit more elasticity around that volatility. I won't get crushed because it's a binary position in that one name versus being in a group of stocks, which is what the ETFs and the indices allow us to do. All right. As always, gang, thank you so much for being a part of Charts and Coffee. I'll see you tomorrow, same time, same station. Be good to each other.